Today, let's ask the question, what is a liquidity trap? A liquidity trap is an economic scenario in which prevailing interest rates are so low that monetary policy, specifically the manipulation of interest rates by a central bank, becomes ineffective in stimulating economic growth. In a liquidity trap, despite low interest rates, individuals and businesses hoard cash rather than spending or investing, leading to the stagnation in economic activity. The concept of a liquidity trap is closely associated with the ideas of British economist John Maynard Keynes. According to Keynesian economics, individuals may reach a point where they prefer holding onto cash rather than putting it into interest-bearing investments, even when interest rates are low. This behavior is often driven by pessimism about the future economic outlook, uncertainty, or a lack of confidence in alternative investment opportunities. In a liquidity trap, central banks typically use monetary policy tools like lowering interest rates to encourage borrowing and spending. However, when interest rates have already hit close to zero, conventional monetary policy loses its effectiveness. Individuals and businesses expecting rates to remain low or fearing deflation may choose to hold on to cash instead of seeking returns through investments. The global financial crisis of 2008 and subsequent economic downturns brought the concept of a liquidity trap into the spotlight. Central banks, including the U.S. Federal Reserve, face challenges in stimulating economic activity despite aggressively lowering interest rates. The zero lower bound, where interest rates are effectively at or near zero, became a focal point in discussions about the limitations of monetary policy. To counter the constraints of a liquidity trap, unconventional monetary policies such as quantitative easing emerged. Central banks implemented large-scale asset purchases to inject money directly into the financial system, aiming to encourage lending and investment even when traditional interest rate adjustments were ineffective. While the liquidity trap is a theoretical concept, its practical implications challenge policymakers to make different changes during economic downturns. The need for a coordinated approach involving both monetary and fiscal policies becomes crucial in addressing the complexities of a liquidity trap and reviving the economic growth. In conclusion, a liquidity trap is a situation where low interest rates fail to spur economic activity as individuals and businesses prefer holding onto cash. This phenomenon challenges conventional monetary policy, requiring innovative approaches to stimulate economic growth during challenging economic conditions. Please note, while we may discuss finance, investing, and money on this channel, this video should not be considered financial advice. When investing or making plans for your own financial security, please seek the guidance of a licensed professional capable of making more informed decisions. If you make a financial life decision based upon the content of this video or channel, then please do so at your own volition and at your own risk. This channel and the people associated with it should not be held liable for your investment choices.